Welcome to Lesson 7, Part B. We are going to talk about contract-to-contract correlation and system-to-system correlation. We have pointed out in the previous video that combining trading systems begets some overallocation, as the systems sometimes overlap with each other as they make use of the same equity. This overallocation is confined to just some market days. Nonetheless, it has to be dealt with. We got from the previous video that the shortcomings of this overallocation are bigger margin consumption, meaning that more margin is needed in order to make the systems work together. Bigger market exposure. The latter, though, can be either negligible, moderate, or considerable, depending on the correlation between the trading systems involved. As far as bigger market exposure is concerned, the term leveraging comes up to our mind. But what is the difference between leveraging and overallocation? The key difference is the correlation. Let's start with the leveraging. Let us assume that we want to leverage an investment on the US stock index by a factor of 1.5, which is something very easy to do with ETFs. Now, let's split this leverage investment into two payoff charts. The bottom has a size of 1. The top one has a size of 0.5. The overall exposure is 1.5, meaning 50% bigger than the equity. That indeed increases the risk with respect to having just the bottom system, because all the losses are amplified by a factor of 1.5. A leveraging of this kind is questionable as far as absolute return investment systems are concerned, and it would be definitely disastrous if applied to a buy and hold investment. Look, owing to the 66% drawdown recorded by the US stock index in March 29, a system of this kind would have lost all the money. Let's take another example. Here we still have a market exposure 50% bigger than the equity, but the two systems involved are not equal. The top one buys the Dow Jones instead of the Standard & Poor. That is not leveraging in the strict sense, as the two systems differ from each other. Nonetheless, this combination definitely increases the risk. The losses of the Standard & Poor, in fact, are actually amplified owing to the correlation between the two stock indexes in question. When the bottom one carries a loss, the top one carries a loss too. If we combine the gold contract with the Standard and Poor contract, we rely on uncorrelated contracts. Thus, we don't increase the risk, even though our market exposure is bigger than the equity. Well, besides, we utilize different trading strategies on said contracts, with different entry prices, different price targets, and stop loss setups. Then, the correlation of these two illustrative systems is nearly zero, and that definitely mitigates the market risk in spite of the overallocation. Let's have a look. When the bottom system carries losses, the top system is likely to carry a profit, and vice versa. Of course, a few times they both carry profits. Let's see what happens with our real-life four-system combination. Let's start with the contract-to-contract correlation check. This analytic makes possible to figure out whether the systems working with the US stock index are correlated to the ones that work with the gold contract. The correlation coefficient is close to zero. There's no correlation at all, which sounds good according to what reported in the previous slide. Now, let's switch our focus to the system-to-system correlation. If we take a look at the single trading systems, we still have a correlation close to zero on average, but we can spot the two systems which are mostly correlated with each other. These are respectively the moderate long system on gold and the greedy long system on gold. That sounds fair, as they work on the same contract and they are both buyers. At any rate, their correlation coefficient is 0.18, which is absolutely negligible. Now, let's move away from our real-life combination so that we can take a look at the more interesting system combination involving more systems. Here we have as many as 10 systems, and a couple of them have a correlation which is close to the boundary indicated by the red horizontal line. Well, let me state a disclaimer. They are nearly half-size position systems in that their allocation weights are 0.65 and 0.50. That definitely would mitigate even the risk involved in a higher correlation, but let's disregard that for a while and let's see what it means having a correlation of such kind. What does it mean to have a correlation of 0.7? In order to appreciate the meaning of this figure, we have to square it. If we square 0.7, we get nearly 0.50 as a result. That is called the coefficient of determination. Well, this new coefficient tells us that 50% of the payoff of one system is determined by the payoff of the other, or vice versa. That is fairly acceptable, as we have a remaining 50% of the payoff of one system which is not related to the other system. That is why the red boundary line in the plot, which marks the acceptance threshold, stands at 0.70. Well, these correlation checks are of utter importance. We have though to admit that they do not cover the entire spectrum of the risk assessment of the investment system. That is just one facet of the coin. The other facet of the coin relates to news flows. I dare say that if the short system on gold and the long system on Standard & Poor stay on the market on the same day, and that is the non-farm payroll day, and the payroll figures are disastrous and they are definitely worse than expectations, we might have as a result that the stock index sinks and the gold rises. In that case, a correlation exists, and it makes both systems carry a loss at the same time. We refer to it as news flow related correlation. That doesn't hold in general, but just on news release days, provided that the news released dramatically impact the market. We may experience something like that once in a 7-year time. Nonetheless, we have to take it into account. It is for this reason that despite the good outcomes of the correlation checks, we are still committed to keep market exposure within moderate levels. We still have to take into account the position size pie chart presented in the previous video, despite the good outcomes of the correlation checks highlighted in this video. These two analytics complement each other. Well, thanks for watching and see you at lesson 8.